Hello, in this video we're going to look at three stocks that are still trading at attractive valuations. I'm recording this in the middle of March 2024. The S&P 500 is up about 35% over the last year. So a lot of stocks are trading at pretty high valuations. Some of them moved up a lot. So just wanted to do a video on a few that are great long-term type stocks that are still trading at pretty good valuations, and we'll look at why that is. So the first one is Alphabet Inc., the parent company of Google. Has a financial health rating from Morningstar of an A. That's the best you can get in terms of solid financial health. Over the last 5 years, it's averaged yearly EPS growth of 21.5%, compared to the S&P at about 9.2% is the median growth for S&P 500 stocks. So more than double the growth. And over the next 5 years, analysts are forecasting 19.3% EPS growth per year. And that, again, is still more than double what the expected is for the median S&P 500 stock. So overall, expected to grow at a much greater pace than basically a typical S&P 500 stock. 17.4% annualized stock return over the last decade. Compare that to the S&P at 12.9%. So the stock has been a really good, solid performer for more than a decade. S&P 500, the PE ratio, which is the price to earnings ratio, this is basically a valuation type metric, is 25.7, and the forward PE, which basically looks at next year's earnings, is 19. For reference, the S&P 500 PE, basically the kind of cumulative average number, is 28.6. So what that basically means is that Google is trading at a lower valuation than the S&P 500, yet still has more than double the growth potential and has historically shown that it can achieve that kind of growth. So let's move on to the next one. Excel Services, a symbol EXLS, a financial health rating from Morningstar, again the best you can get in terms of financial health. 27.7% yearly average EPS growth over the last 5 years. For reference, again, we were looking at about 9% for the S&P 500. 14.7% forecasted yearly EPS growth over the next 5 years. Again, S&P is around 9% average for S&P 500 stocks. So this, again, a much better growth potential stock. 8.2% annualized stock return over the last decade versus what do we have for the S&P? About 12.9%. So again, a really strong performing stock, and these are one of the reasons it tends to have bigger growth than a typical S&P 500 stock, so it should outperform the S&P 500. Price to earnings ratio is right around where the S&P 500 is. Forward P quite low compared to the S&P 500. And again, we have that higher growth story. So trading at a similar valuation to the S&P 500, but it has a higher growth potential, which should indicate that it continues to outperform the S&P 500. Let's look at the last one. WRB financial rating, so still really solid, just not quite as good as an A rating, but still A, B. Very solid, financially healthy companies. 17.8% yearly average EPS growth over the last 5 years. 9% forecasted for yearly growth over the next 5 years. And so that's a little lower. That's more in line with the S&P 500. It's been, at least of these three stocks, the best performing, 19.4% annualized stock return over the last decade. So that basically means 19.4% per year, compared to the S&P, which was around 12. And PE, much lower, 17.8, and forward PE of 13.2. Now that's fairly common for WRB as an insurance company, so insurance and financial companies generally trade at a little bit lower PEs. So here we have a more attractive valuation but growth a little bit lower. But this company has still proven over the long term that it can generate great growth and great stock returns due to that growth. So I think it's still a good combination of growth combined with favorable metrics. Let's quickly look at these charts. Google, moving back up, was a little bit weaker and has been jumping back up. Let's change this to regular. And it started to move back up. EXL really kind of struggling in this year, even though the market's been pretty strong. It's kind of floundering a little bit, moving sideways, which helps explain why it's trading at a decent valuation, because it hasn't had the big run up that a lot of other stocks have had. WRB, had this one on my list for quite some time as it came out of this big rounded bottom and continuing to run higher. So in an overall uptrend, if you're looking for entry points, you could look for like a little pullback like these ones that we've seen in the past. But overall, those are how the charts are looking. But mainly this is about a financial, how they are looking financially and fundamentally, as opposed to just necessarily their stock charts. And yeah, full disclosure, I will likely, I own some of these and will be buying more of them, and just because I think they're solid companies and they're still trading at an attractive valuation at a time when a lot of stocks aren't. So for a long-term buy and hold type portfolio, I like to have these in there. And always, even though these are buy and hold investments, they're buy and hold in the sense that as long as these companies continue to produce these types of metrics that we're seeing here, then that's great. As long as they're kind of above average or trading at better valuations, things like that, then I continue to hold them. If these really start to decline off, then we look for something that has more attractive metrics. So it's not a buy and hold forever. It's a buy and hold as long as they continue to perform well and are producing these types of metrics that we like to see.